The due on sale clause is obviously the boogeyman in creative finance transactions. And by that, I mean, on one hand, it's the most frightening potential piece of the creative finance deal, but it's also the most rarely seen. Compared to maybe even if we were to talk about all the liabilities that might attach in creative finance, you could make a good argument that your failure to disclose a lot of what you're doing creates much more liability than what you would ever have to worry about with a due on sale clause. But it's out there and it's something that needs to be addressed. And it's rarely seen, I think, but it's something we've actually seen in pretty recent history, right?
Yeah, it happens. Lenders do invoke the due on sale clause. And it really depends, in my view, who your lender is as far as the chance or the likelihood that the due on sale clause is going to be invoked. So if the lender that makes the loan also services or holds the loan and they don't, securitize it or wholesale it so that it becomes part of a larger fund, it basically becomes part of a stock portfolio or mutual fund with many different owners that hold it basically in trust. That's what securitization is, right? You basically pool and package loans and you put them out in the market, and people can actually buy very small interests in those. And you have, I'm sure you and I, in our retirement accounts, we hold some small percentage of a loan portfolio as part of our investment strategy, because most, mutual funds include that type of investment. And so
Sure.
they basically are there and they're packaged, they're securitized, they're bought and sold in the open market. And you have some trust that, basically holds it for the benefit of its, hundreds of thousands of investors that are out there that hold a very minute, percentage of the loan. Well, that trust isn't going to be the one that services the loan. You have a separate company that services it. What we mean by servicing it is they don't have an ownership interest in the loan. They have the right to collect payments, and then they get paid a very, very small percentage of every payment that they collect. And then they pass the rest on to the actual holder or the trust that's holding the loan for the benefit of all these investors. Now think about that. If a servicer is getting paid and they're putting even a small percentage of that in their pocket, do they really care who's making the payment? Do they care that the loan is, it's been sold? They don't own the loan. They don't bear the risk of the loss. All they want to know is, hey, I'm getting paid. I'm passing the money on to this, investment trust. They're happy. They're getting their money. We're all happy. Nobody cares, right? Now, who cares is Fannie Mae, Freddie Mac, who, is insuring these loans. And, they're federally insured. And so it'd really be incumbent upon Fannie Mae, Freddie Mac, or the insurance company to basically do random audits to figure out, whether or not the property has been sold and whether or not it makes sense to, move forward with accelerating the debt. Does it happen? It can happen. I'm not aware of it happening on a regular basis. It's less than a 5% chance from, in my experience and my research is less than a 5% chance that the lender is actually going to call it. So if you're dealing with what we call a conventional loan insured by Fannie Mae, Freddie Mac, it's a very small likelihood that, the servicer is going to see, hey, the payment's coming from somebody else, or the insurance is listing somebody else as the insured. We're going to now go and call the loan due when in reality, we're getting our payment every month. We're getting paid. We're making the holder happy by passing the payment on to them. Nobody, is going to, in my view, be concerned about it. I mean, they're all looking out for their self-interest, right? And their self-interest is just keep the loan good. I mean, we're getting paid, right?
Right. Yeah.
And so that's number one. The other type of loan is your smaller community bank loan, your loan where it was funded and held in service. So we call those portfolio loans. They're not securitized. They're not bought and sold out there on the open market. They're portfolio loans, and those lenders are going to be a little bit more on top of it. And that's the most recent case that I'm working on where the lender did call the loan due is the lender funded it, but also maintained it as part of their portfolio. Even though it was a large lender that you would have thought would have securitized it, they didn't. They held it as part of their portfolio. They did, a random audit, found that the property had been transferred, and then said, "Hey, look, either put the title back in the seller, or we're going to accelerate." So if it's a portfolio loan, yeah, they have a much smaller pool of loans that they're handling. They're going to be looking and doing, their random audits. They may have people who receive the payment and look and say, well, why is this coming from so-and-so and not the borrower? Why is the insurance showing so-and-so as the insured? So, your percentage of the due on sale clause goes up a little bit when you're dealing with those types of loans. I don't know how much, of a greater percentage that is, but it's a greater percentage for those types of portfolio loans. FHA loans, you have a little bit more risk too, because the FHA does not want or like their loans wrapped. And so if you're going to do a wrap, FHA doesn't like that. And they, take steps to try to, discourage that, to prevent it. And one of which would be, calling the loan due. So, that's something to consider too on an FHA. VA, they're serviced and held the same as a conventional loan. The only difference is that the VA insures it. And so the VA, similar to the FHA, will maybe do a little bit more auditing than you might see with, a Fannie Mae, Freddie Mac loan. But nevertheless, VA is similar to FHA, and then they don't, it says it right there on their deed of trust, like, hey, don't convey the property or try to have someone else assume the loan without getting our, written permission. And it says it there. So they give that warning. They clearly intend to enforce the due on sale clause, and it's obvious by their documents. So you may have, a little bit more risk with a VA. It's not illegal to wrap a VA loan or an FHA loan. It just basically puts you within the due on sale clause provisions, which means that the lender has a right to accelerate if they so choose on that loan.